welcome to our halftime report presentation. For those of you that don't know me, my name is Chad Stacekel. I'm the managing partner here at Eagle Wealth Management. We're delighted you could join us, and we look forward to sharing some important updates with you. So, just because we like to make everybody happy, including our compliance and all those financial regulators, we'd like to draw your attention to some of these disclosures. Please take a moment to read them over, but to sum it up, we're providing opinions, forecasts, statements, and slides we believe are factual and from reliable sources. But our conclusions and judgments are subject to change without notice. And by no means are we selling anything in this presentation. One of our goals today is to discuss some of the factors that influenced 2021's market performance thus far, and then review the underlying fundamentals. It'd be impossible to cover everything in that's happened so far, but we believe focusing on some of the key developments may give a clearer picture of the markets. Today, we're going to review where we've been, some key economic fundamentals, and what may lie ahead in the second half of the year. This broad view is designed to help you stay informed, hopefully give you a little better understanding of some of the perspectives that help guide some of our investment decisions. So let's begin by reviewing the stock market, how the stock market has performed so far in the first half of this year. Here's a snapshot of the S&P 500 index performance from December 2020 through May of 2021. The S&P 500 index tracks the market capitalization of 505 of the large U.S. domestic stocks. The index is commonly viewed as a benchmark for analyzing the performance of the U.S. economy. The S&P 500 climbed rather steadily for the first 6 months of 2021, despite the headwinds of political uncertainty and a slow start to the vaccine rollout. As the inauguration of President Biden proceeded on schedule, investors were soon able to focus on some of the economic fundamentals and progress on managing some of that COVID-19 infections that we're getting Americans vaccinated. Markets, they were lifted by a series of positive developments, whether in the form of additional fiscal spending or the acceleration of the vaccination. March saw some particularly noteworthy developments in the passage of the 1.9 trillion, that's with a T, stimulus spending bill, and the milestone achievement of 100 million vaccines administered. In April and May, markets reacted to solid economic numbers, highlighted by the April jobs report and calculations that the U.S. economy grew at 6.4% annualized in the first quarter. So we've talked a lot about how the S&P 500 performed during the first half, but how does that performance compare to expectations? So let's explore. At the end of each year, various media outlets compile mini Wall Street analyst predictions for the year ahead. This slide shows several projections shared at the end of 2020. So how have those predictions compared to reality so far? Well, from the previous slide, we could see the S&P 500 closed at June 30th at 4,297. Well, the S&P ended 2020 at 3,756. So some of the forecasts for 2021 were aggressive and some were modest. As you can see from the table, the market had already exceeded some of the analysts' forecasts for the entire year. So let's be fair, this is not the end yet. Many market watchers also felt coming into the year, the market would see its biggest gains early in the economic activity as corporate earnings picked up from 2020. The second half of the year, a little bit more of a question mark. Predicting where the S&P 500 will be by the end of the year is always challenging. There's also a pandemic we're still trying to get through and other uncertainties emerging. It's worth repeating, the S&P 500 index, it's still not through the end of the year. But what we like to glean from this slide is that the majority of market analysts believe the markets would have a positive year in 2021. Beyond the US stock market, there's also many other asset classes that we like to watch. As you can see here, it's actually been a very positive year to date, and 1 year and 3 year for most asset classes, but not everything. One of the things that we're going to talk about is inflation. And what I like to point out is that a concern seeing oil prices have gone up over 88% in the first half of 2021. But if you look back over the last 3 years, oil is still actually lower than it was 3 years ago. So we like to keep a lot of these expectations of inflation and broader market pictures when we're looking at overall investments. Let's take a look at some of the economic and financial indicators and help us understand how we got to where we are today. To put today's economy into perspective, let's look back to January 2011. This is the last time we had a similar point when we had come out of a serious recession like we did with the COVID in March, April of 2020. Back in January 2011, it appeared that the 2008 crisis had finally gotten behind us. Here you see the 20 speedometers representing the 20 indicators. These kind of go from corporate profits, energy costs, market valuations. And when we look at this, you can see the 16 of the 20 indicators were in a shade of green, which suggests the economy has a solid foundation. Just one indicator at that time was red, which was political environment. When we look at these indicators, we're looking at what we think the economy will do in the next 3 to 6 months and how the metrics are stacking up for positive or negative headwinds or tailwinds to the US economy and ultimately the stock market. So let's fast forward now 10 years to January 2021. As we can see here, 10 of the 20 indicators were reporting positive and strengthening numbers. But you can see that an equal number of indicators had neutral or negative ratings. In particular, the political environment and geopolitical risk were also in red. By May, the speedometers indicated much improved outlook. 17 were green, 3 were yellow, and none were red. These improving conditions reflect a number of key developments, including an acceleration in vaccine distribution, falling new infection cases, additional fiscal stimulus, and improving economic numbers. Let's just take a few minutes to talk about COVID-19, the infections and vaccinations. Some believe progress on this health issue was a necessary precondition to an economic recovery. As the chart shows, new COVID-19 infections appear to have peaked over the latter part of 2020 and early 2021, followed by a sustained downward trend in mid-January. This persistent decline has helped investors believe we might avoid another strict lockdown. One of the reasons the downward trend of COVID-19 cases was that Americans were being vaccinated in greater numbers. After a slow start, the involvement of the national drug retailers helped accelerate the pace of vaccines in March and April. As the chart shows, about 50% of the US population had received at least one vaccination by June, getting the stage to a broader economic reopening for the second half of the year. In addition, and probably more importantly, 90% of people over the age of 65 had gotten at least one shot. Now, one of the things we do have to pay attention, again, when we look at the overall amount of asset classes and in the world that we invest in, is that not all countries are created equal. Global prospects are improving, but very different rates. Obviously, as we can see in North America, the US and Canada are leading the way with pushing vaccines and getting the recovery a little quicker. But as we can see here, there are also a lot of Asia and Africa, and Australia is still far behind. So we are watching the different developing rates in which we're seeing COVID hopefully getting eradicated or at least slowed down to bring back most of our economy. What we also want to notice is that you can see that not all countries are recovering equally either. In December, the estimate for growth in the US was 3.2%. And as we can see by June, it was up to 6.5%. There are certain areas, as in Europe, where we do see it still lagging behind, also in China. So as we continue to watch, this does help guide some of our decisions and where we think that it's better to be looking to invest. One of the other areas that we're going to be talking about is inflation trends. And what does it take to keep pace with inflation? As we invest, one of the things that we hear a lot from clients is this desire to have safety. Well, safety is good. And when we look at it, what do you get paid in cash? What do you get paid in safer bonds? And what we're seeing is as inflation does tick up, one of the things we do have to start looking at is what does it take to equal out or break even with inflation, and what interest rate do you need to get? So as we're looking forward, we're trying to find different ways in which we can invest our money, still try to keep a relative level of safety, but still able to also keep up with inflation that we do see increasing at this moment. Let's take a moment just to talk a little bit about wages and unemployment. This graph shows the unemployment rate on a year-over-year wage growth for the last 50 years. And I don't know if you can notice anything that seems a little bit strange at the very end of this chart. You notice most of the time, wages and unemployment have an inverse relationship. When one goes up, the other goes down. Notice how wages rose while unemployment spiked during the pandemic period. One of the reasons for this break is that wage growth and unemployment relationship was that job losses were mostly in low wage areas of our economy that were shut down by the pandemic. Remarkably, just after a year of unemployment jumping to nearly 15%, the unemployment rate has dipped to its 50-year average of about 6%. Hiring picked up in the first half of the year thanks to widening economic reopening and a broader vaccine distribution. Many economists expect the recovery in labor market to continue on as more and more Americans look to spend and travel. As we look at this chart, this is one of the areas I really like to focus on when we're looking at all the different factors that lead to some of our investment decisions. This chart, since we were looking at the first half of this year, our numbers really only go up until March. But as we can see from the peak right before COVID hit in February, March of 2020, that we are almost got our gross domestic product back to where we were. We've actually exceeded that to where we are now at a higher level of GDP than we were prior to the pandemic start. More importantly than that, corporate profits by March of 2021 had already exceeded where their peak profits were back in March of 2020. When we look at manufacturing and payrolls, those also have gotten back to their higher levels than pre-pandemic times. One of the questions that we get more than anything in the last 6 months, I get this question more in the last 6 months than I have in the last 6 years, is what is going on with housing prices? Housing is an important contributor to economic growth. And new housing starts increase demand for everything from labor to construction. So as we look here, from prior to the start of the pandemic, housing prices have increased over 22%. Not only that, you add on what could cause that increase is housing supply is down almost a third. And you add on to that, mortgage rates are significantly lower than they were prior to the pandemic. And then you add on top of that the cost of building, with lumber prices and most materials and labor costing quite a bit more. The question we're getting a lot is, do we think that we're back into a time when, like in 2008, when housing prices could get cut by 40 or 50%? And I'm going to say we're not seeing the same type of data that we did in 2008. Most of the houses are getting bought with cash and also with solid financing, meaning that it's not stated income loans. We're also seeing a lot more money that's being saved. And speaking of money being saved, it may surprise you is that Americans' balance sheets really have improved in the wake of one of the nation's most rapid and deepest recessions, which of course was ignited by the economic lockdown caused by the coronavirus. As the charts here show, Americans' net worth rose over 16% throughout 2020, while liabilities actually dropped. So when looking at these different slides, a key to point out here is that why is everything costing so much more? Well, people are feeling flush with cash right now. Net worth is up 16% from where we were at the prior to the coronavirus recession. Debt service, how much debt people have. People have been able to pay off their credit cards, pay off loans on their cars, pay down on their houses. And so with less debt, more income, they're spending more money on goods. They have more to buy, hence why. Why are used cars so much selling now? Why are car dealerships not having supply? Because people are buying right now, they're buying goods. We are seeing up through basically March of 2021, spending on services still hasn't gotten to that level yet, but we actually surpassed it by the end of June. So before we move on for the second half, I've talked a lot of positive things we see going on, but let's take a moment to consider the variables that could really send markets upside down. We see three major probabilities, that could upset an otherwise optimistic outlook. The first is inflation. While we are looking at it and talking about inflation being transitory, meaning that we don't feel inflation is going to continue on, the Fed has remained steadfast in its position that inflation will likely stay as transitory. And as a consequence, it sees no need to change its current economic accommodative monetary policy regime of near zero interest rates, meaning they are going to try and allow the markets to continue to move forward unencumbered and keeping interest rates at very, very low rates. But what if inflation is not transitory and continues to rise? What if inflation regularly exceeds the Fed's goal of 2%? Well, another risk that we could see is bond yields. Many investors expect bond yields to increase for a good reason. Strong economic growth will drive demand for credit. But if that increases higher and quicker than anticipated, it could unnerve investors as bond rates continue to rise, where some investors may decide they would rather invest in bonds rather than in stocks. Also, there could be a deceleration in the growth of corporate profits. Corporate profits are at record-breaking momentum right now. Some of the largest companies are having huge profit growth coming out of the pandemic. What if that slows down? Finally, there's always the so-called black swan event. I would say coronavirus, a global pandemic, would be a great example that's in recent memory. There's something that no one could expect, but it could show up and it could upset markets. While there's no way to plan for those, they are part of what we know as a normal part of our market. So, of course, no one can predict what's going to happen in the future, but we hope the following perspectives help you understand a little bit about what we see on the horizon. Let's dive into forecasts for the second half of the year. Let's start with inflation. Inflation is by far the number one question that we are getting right now, is what if inflation continues? What if we keep seeing this? And what we are seeing here is obviously that the consumer price index. This is one of the main indexes that we use to look at what consumers are paying for different products. And as you can see within the products, you can see housing represents 40% of what the consumer price index is made up. And you can see most of that is flat. The two outliers right now are obviously transportation, the cost for travel, airlines, rental cars, hotels, used cars. Transportation has gone through the roof. So has apparel. Both of those areas are well above our normal rates for inflation. Now, we don't think that we're going to see a reason why we feel that this is probably more transitory is because as we are coming out of the pandemic, the built up demand that from not spending for half of 3/4 of a year to now where we're coming out and we're able to buy those things to get back to normal. So what type of trends do we see, and why do we think that? Why does the Fed and why are we also in believement that the inflation is more transitory, meaning that it is not going to stick with us, and we're going to go back to that more normalized 2 to 2.5% inflation? Well, what we're seeing here is there's a lot of structural forces built into our global system. I'm going to take the first one, which a lot of you know already, is the Amazon effect. There's price transparency. If prices start getting too high, then what ends up happening is more competitors come in, and that will drive prices back down. There's also the flexible and competitive labor markets. We're not seeing the huge union pushing prices up anymore. There's a lot more competition, and above that competition, there's globalization. If in the US, things cost too much, we are going to find other people, other countries coming in with their companies to be able to compete to bring prices back down. So if inflation has come up and we think it could stay up a little while, and what kind of effect is that going to have on the stock market? Well, modestly higher inflation typically does not derail a stock market. As we can see in this chart here, you could look at it and say, right now, inflation is currently in that 2 to 4% range. The average S&P 500 return when inflation was between 2 and 4% has been 8.5%. Well, what if it shoots up to 4 to 6%? Well, what we can also see is that inflation, the average return in the S&P 500 was 8.7%. So what we have seen is that stocks can actually be a very good hedge against inflation. Why? Because corporations have the ability to be able to raise prices when inflation is part of it, because they're raising those prices knowing that every company has to raise prices. So if inflation is taking off, one of the concerns would be is, what is the Federal Reserve going to do? Well, they have said for some time they are planning on leaving interest rates the same, which is near zero. And this is interest rates that allows for companies and banks to be able to borrow at low, very low monies, which is right now near zero. And so the Federal Reserve has said they're not going to raise rates until 2023. So when we're looking at that, is that this accommodative, meaning very a nice tailwind to the stock market, is if interest rates are near zero, that allows for stock profits and money made in the stock market to be easier to obtain. So one of the things we also look at is that the Federal Reserve also has many voting members, and some of those voting members are allowed to make predictions and say, what do they think that the Fed funds rate will be at in 2023 once they say they start to raise rates? What you can see is the majority of the members still feel that rates are going to stay very, very low. Only a couple out of the group said that they're going to get up to 1.625 or 1 5/8, which, if you're looking back just not even 2 years ago, the Fed rate was actually at close to 2.5%. So even in 2023, the Fed and where borrowing money and easy money policy is still going to be with us probably through 2023, even with the numbers we're getting for inflation right now. Another area we're watching very closely is the stimulus. We talked earlier about back in March when a $1.9 trillion stimulus package came into our economy, hence pushing up the stock market. Well, as of right now, we're actually in the discussions and we're seeing a bipartisan agreement of a $579 billion infrastructure spending bill. And right now, they're not talking about any new taxes. So when you look at, again, low interest rates, more stimulus coming in for infrastructure, and we take on top of that is that right now there's still another 1.5 to 2 trillion, again another T, reconciliation bill that could be on the horizon that would help with more human capital, environmental goals. What we're seeing there is that type of possibility is another product that is going to continue to hold and push the stock market in our economy forward. Just looking forward, where we were from the second quarter of 2020 when our GDP had historically record-breaking losses of over 31%, we are now seeing a consistent growth. Now that growth in 2021, we are thinking is going to probably end up somewhere in that mid-6 range. So very high gross domestic product growth. It averages normally around 2%. So to get close over 6%, we're growing at 3 times what we did in the prior years on average. Now we do feel that it is going to slow down in 2022. Again, going back down to that 2.5 to 4.5, but which is still above our historic average of GDP growth of 2.3%. One of the questions we get quite a bit when looking at investing is, boy, stocks seem very expensive. And when we look at stocks and we look at bonds, what we're looking at is a lot of times the ratio of what kind of a yield and what kind of income do we have on our stocks compared to bonds. And one of the things we can see here is that with it, when we compare competing with inflation, is that stocks still actually look fairly attractive right now to bonds. Oops, sorry, I skipped ahead there on one there. Sorry about that. So when we're looking at going back, I apologize. We're actually going in there, the challenging environment for bonds. Interest rates are so low, and we do expect as those go up. And what there's an inverse relationship between bonds and stocks. And that inverse relationship means that as interest rates go up, it makes it so that bond prices go down, meaning that if you can buy a higher interest rate asset, something paying 5% interest, you're going to pay less for something that pays 3%. So we do see that this being a little bit of a challenging environment for bonds. Now, do we say, hey, you should be out of bonds altogether? Absolutely not. We're not making recommendations here. But what we are saying is we have to be prepared that bond yields in keeping up with inflation will be a little bit more challenging moving forward. And hence why we talked about what I was covering up before is equities are still actually looking fairly attractive versus bonds when we look at interest rates more than likely going up in the future, as well as keeping up with inflation. One thing we always like to really have conversations with clients is understanding that not all bonds are created equal. Not all fixed income is created equal. A lot of our clients are in retirement stage and understanding they need income. And what we do is we look at a lot of different types of what we call fixed income and bonds. High yield is one example. There's also emerging market and secured notes and loans. But when we look at this, the amount of spread or amount of extra yield you get from high yield bonds compared to traditional bonds, even though they may be a little bit more risky, that risk seems to be more than getting compensated for by a higher degree of return. So when we're looking at that, is even if we may say, if we've talked about the ability to be able to shift a little bit more to some opportunistic and fixed income than just sticking with those traditional bonds where we see a little bit more concern with rising interest rates. So let's talk a little bit about kind of the critical factors we see moving forward. First, the tailwinds. This is what we've already talked about going through these slides. One, high levels of confidence. We see right now when we're looking at the majority of our charts, it's mostly in green. Upward trajectory of earnings. Right now, corporations, they're coming out with over 80% beating their expected profits. More fiscal stimulus, more money coming into the economy. And when consumers drive 70% of the gross domestic product or GDP, those consumers have money, they're spending more. And supportive monetary policy, meaning that the Fed is still keeping interest rates really low. So what's the headwinds? Well, let's talk. That's pretty easy. High valuations. Stocks are already trading high. We're not the first ones to say, hey, we think things look really good. Hence why we believe the stock market is actually already pricing in where they're going to be 6 months from now. Rising interest rates. Well, even though the Fed says they're not going to raise interest rates until 2023, there still is a concern they may raise earlier because of the fact that their concern is inflation might get a little bit more out of control than their concern. Potential tax increases. With that more stimulus comes the possibility and likelihood that we will see tax increases. Now, while we're not concerned for most people when it looks at those tax increases, most of these tax increases are for those who are making $400,000 a year or more. Another area of headwind is we're just seeing these pockets of speculation. When we see this type of speculation, whether it's cryptocurrencies, certain what we call meme stocks, the GameStops, the AMCs, when we see that kind of speculation, that typically is the signaling that, you know, there's a little concern that people are getting greedy. And when that happens, there starts to be more of a concern of larger pullbacks. So here's where we are today. I showed you prior to April, here's where we are looking right now. So as of end of June of 2021, we can see that again, 17 of the leading indicators saying where are we looking 3 to 6 months, 6 to 9 months in the future. And you can kind of see again, the dials, except for especially the consumer spending, really ratcheted up there into the high green. Interest rates being low, fiscal policy being high in that green. Business outlook, you can see, is just driving up. We are seeing a lot of money getting spent by consumers and by businesses. What does that mean? That's when we see lots of more profits. And when we see more profits, we see higher earnings. When we see higher earnings, we see the stock market continuing to be able to rise, even at these high levels of their equity market valuation. So what this is saying to us and we're looking for is, what is the probability of a recession coming? This is kind of one of our big fears that we always are watching for, is we're looking for when those big downturns happen. Obviously, we know recessions can happen by black swan, like a pandemic that comes out of nowhere. But when we're looking at what could lead to a pandemic right now with the normal economy, we're seeing really low probability, less than 30% easily of a recession coming in the next 12 months. So let's just talk a little bit. Let's just kind of finish it up. A vaccine return to normalcy kicks off hopefully a multi-year expansion. One of the things I'm going to say is, yes, we are going to keep expanding, but I will say, understand we expect that it will be much more muted stock market returns based on the valuations we're at. There's improved sentiment, savings, stimulus, reopening that we're seeing. Now, again, we are hearing concerns with the Delta variant and that we could have a slowing again, but we don't believe that that is going to be long-lived. Inflation's, while it is a concern, we see it as a short-term concern. Fiscal spending and stimulus continue to drive the markets, give consumers more money, and it's likely there will be some tax increases, but we're again focusing, that's going to mostly be just hit a lot of the higher income, small percentage of U.S. residents. And the Fed, it's also remaining committed to accommodative policy, helping to really push our employment goals, rates back to very low levels. So that was a lot, I know. So tuning out the headline noise while manage your finances is not always easy. However, wise investing involves more than reacting to headlines, and as we've discussed, consumer sentiment or geopolitical developments. For investing opportunities, one approach that we always stay focused on is to approach and stay focused on fundamentals like companies' earnings and economic data. So we've gone over a lot today. And if you remember just one detail from our presentation, we hope it is emotions have no place in investing. We've got to look at the big picture. Market corrections are a normal part of market cycles. We saw a very vivid and compressed illustration of this back in March through May of 2020. We get a lot of conversations about, you know, what if the market has this big sell-off? What if it's not a what if, it's a when. This chart shows an inter-year low each year going back to 1980, with annual returns showing in gray. In 2020, we experienced a 34% decline intra-year for the S&P 500, but it also ended up the year up 16%. Volatility is uncomfortable, but it's normal. Managing your emotions during good times is just as important as during bad times. Ultimately, taking a long-term view of markets is essential in pursuing your long-term goals. If you're feeling concerned or want to understand what's happening, lean on us. We are not paid like the news channels to tell you all the fear mongering to get you scared. We are meant to bring what is one fact and bring it into the big, ultimately puzzle piece. Take that one puzzle piece and make it into the big puzzle that we say, hey, here's really what everything looks like. And the other one is when we turn out the noise. If we look at the last 15 years, you see a danger of missing some of the market's best days. As the chart illustrates, a 10,000 investment in 2006 would have increased over 41,000 by 2020 in the S&P 500. But had an investor pulled out just 10 of the best days, their return would have been less than half of that. One area we like to talk about is the fact that the majority of the best days in the S&P 500 are followed within 2 weeks of the worst days in the S&P 500. Market timing does not work. So when we want to look at this, we want to talk about keeping emotions out. We want to talk about staying invested based on your plan, not based on market moves. That's it for today. Thank you so much. As you can tell, our whole team is passionate about helping you understand the markets. For more information, timely updates, feel free to follow us on social media, read our weekly emails. We hope you enjoyed the details we shared today, and we look forward to hopefully talking to you all again very soon.